2025 is already looking very different for investors. Just a couple days ago, the Federal Reserve cut interest rates by 25 basis points, the first cut in this new cycle, and they forecast 5 more cuts from now through 2026. In other words, we are officially entering a monetary easing era. Historically, that's when the stock market performs really well. In fact, since 1980, the S&P 500 has averaged more than 14% returns in the first year after the Fed starts cutting rates. But here's the thing. Not every ETF benefits equally. The right ETF could double your returns over the next few years, while the wrong one could hold you back. So in this video, I'll walk you through the exact framework for picking the right ETFs for 2025. Dividend yield and growth potential, expense ratios and hidden costs, sector exposure and diversification, growth versus income trade-offs, and even where covered call ETFs fit into this new market cycle. Before we even look at a single ETF, we need to understand the backdrop. The Fed is cutting rates, and not just once. Yesterday's 0.25% cut is just the beginning. Their forecast calls for 5 more cuts through 2026. This matters because when borrowing gets cheaper, companies can invest more, expand faster, and earnings often surprise to the upside. Investors rotate money from cash and bonds back into stocks because holding cash pays less and less. Historically, equity markets love this. Data from Northern Trust shows that over the last 9 easing cycles since 1980, the S&P 500's average return in the 12 months after the first cut was 14.1%. Over a full easing cycle, equities have historically gained around 30% on average. Bottom line, this is a potentially bullish setup, but you still need to be selective. Which sectors benefit most? Which ETFs are positioned for growth versus steady income? That's what we'll break down next. The first thing I look at is yield, but not just yield, quality of yield. If you're focused on income, dividend ETFs are attractive. Look at funds like SCHD or VYM, which offer 3 to 4% yield and have a track record of growing payouts. Dividend growth beats inflation over time. But don't chase yield blindly. A 9% yield from a risky ETF might look tempting, but could mean price erosion or unstable payouts. Growth ETFs like QQQ, VOO, or sector-specific funds may have little or no yield, but they ride price appreciation, which historically outperforms in rate cut cycles. And then we have covered call ETFs like JEPI, JEPQ, or QQQI, which use options to generate income. They can pay 7 to 10% annual yield, which is great for cash flow, but they cap upside in strong bull markets. So in 2025, the decision is, do you want income now, growth later, or a mix of both? For many investors, a blended strategy, some dividend ETFs plus some growth ETFs captures both worlds. Check the expense ratio. Fees quietly eat away at your returns year after year. SCHD charges just 0.06%, which is $6 per $10,000 annually. Some thematic ETFs can charge 0.50% or more, which is 5 times as much as SCHD. Over 10 to 20 years, these small differences can compound into thousands of dollars lost. Also check liquidity by ensuring the ETF trades with a tight bid-ask spread. Additionally, evaluate tracking error to see if it follows the promised index closely. These small details, like expense ratio, liquidity, and tracking error, separate good ETFs from bad ones. Paying attention can greatly affect your investment returns. After fees, look under the hood. Identify the sectors your ETF is concentrated in. In 2025, sectors likely to benefit most from rate cuts include technology and AI, real estate, REITs, financials, and industrials and cyclicals. Don't forget defensive sectors like consumer staples and healthcare for stability during periods of volatility. Diversification across sectors and regions provides a balanced portfolio. For example, pair a U.S. large-cap ETF like VOO with international exposure through VXUS or an emerging markets ETF to achieve extra diversification. Finally, consider growth potential. When rates are falling, growth assets like tech, semiconductors, cloud computing, and clean energy often rally the hardest. You might overweight a growth ETF or thematic ETF during this cycle. However, remember that growth can swing 20 to 30% in both directions due to volatility. If you prefer steadier returns, mix growth with dividend growth ETFs or covered call ETFs to smooth out the ride. Let's compare two hypothetical portfolios over the next 2 years. Portfolio A, 100% growth ETF, high upside potential, but big swings. Portfolio B, 50% dividend ETF plus 50% covered call ETF, lower volatility, steady income, but capped upside. In a strong rate cut rally, Portfolio A might outperform with 20 to 25% gains, while Portfolio B could deliver 10 to 15% with lower drawdowns and steady income. This shows why a blended approach is so popular. It allows participation in the rally while providing cash flow along the way. So here's the 2025 ETF playbook. 1. Start with your goal, growth, income, or both. 2. Check yield, but make sure it's sustainable. 3. Keep expense ratios as low as possible. 4. Look under the hood for sector exposure and diversification. In this new rate cut cycle, consider a little more growth exposure, but balance it with dividend and covered call ETFs to protect the downside. If you want me to share my personal watch list of the top 5 ETFs for 2025, including growth picks, dividend growers, and covered call income funds, drop a comment below. And don't forget to subscribe because we're just getting started with this easing cycle and you don't want to miss the rally.